the functions of money. So you might be thinking that we just use money to buy things, go out and buy clothes or something, but actually there's a lot more uses. There's four main uses of money. So first off, it's a medium of exchange. It's a way that we can buy things. So this is good because it avoids the inefficiencies of a barter economy. Now, a barter economy, just to let you know, is when you exchange things without money. So, for example, they'd use it in the olden days, where if I wanted to buy a cow, I might give the cow farmer 100 sacks of potatoes. I don't really know, but that type of thing. You get the idea. So, for example, it avoids the dependence of the occurrence of a coincidence of wants. And what I mean by that is, if I really wanted a cow but the farmer didn't want my potatoes, then that wouldn't be good. So you need both parties to want what the other party has, and that can be quite inefficient. So this is why money is a good medium of exchange. It also is a good measure of value because the prices of a good reflects the value society places on them. So that's pretty straightforward. And it can be used as well as a standard of deferred payment. So this means that money is used as a benchmark for specifying future payments for current purchases. So that's buying now and paying later, like taking out a loan, for example. So actually, a good example is a car loan. So if someone gets a loan to buy a car today, then they may pay off the loan with payments deferred into the future. And the amount of those payments is stated in terms of money. And deferred payments need to anticipate future money values based on future inflation. So, for example, if inflation is set to be 10% next year, say that's quite a high amount, but we'll go with that, then deferred payments need to be adjusted for the resulting decline in the money value. So if you only put the value of money at £300, but there's going to be 10% inflation, then if you're just paying back £300, then the person who loaned you the money is losing money. So say you've got like a 2-year loan of £300, they might charge you £330 to anticipate that 10% inflation. So they have to be adjusted for the resulting decline in the money value. And this inflation adjusted is accomplished through interest rates. So interest rates show the value of inflation, and they also probably take a little cut for themselves. And then a store of value, well, you can just keep money in a bank rather than okay, potatoes don't go off, but we'll say milk. If you've got loads of milk and you want to pay for things in milk, milk's going to go off, so it's not going to store the value. And then you can't use it to buy sheep this time, we'll say. So that's why money's good, because it can be stored. It's a perishable good. Thanks for listening. Please like, share and subscribe to my YouTube channel at Bitesize Economics.